I continue to read the article on Reflexivity by George Soros. Now, Section 4, Financial Markets. Financial markets provide an excellent laboratory for testing the ideas I have put forward in the previous sections. The course of events is easier to observe than in most other areas. Many of the facts take a quantitative form, and the data are well recorded and well preserved. The opportunity for testing occurs because my interpretation of financial markets directly contradicts the efficient market hypothesis, which has been the prevailing paradigm. The efficient market hypothesis claims that markets tend toward equilibrium and that the deviations occur in a random fashion and can be attributed to exogenous shocks. It is then a testable proposition whether the efficient market hypothesis or my theory of reflexivity is better at explaining and predicting events. I contended that my theory of reflexivity is superior, even in its current rudimentary stage of development, for explaining and predicting financial markets in general and historical events like the financial crisis of 2007-2008 and the subsequent Euro crisis in particular. My conceptual framework. I will first describe how the three key concepts of my approach, volability, reflexivity, and the human uncertainty principle, apply to the financial markets. First, volability. Market prices of financial assets do not accurately reflect their fundamental value because they do not even aim to do so. Prices reflect market participants' expectations of future market prices. Moreover, market participants are subject to volatility. Consequently, their expectations about the discounted present value of future earnings flows are likely to diverge from reality. The divergence may range from the negligible to the significant. This is in direct contradiction of the efficient market hypothesis, which does not admit volatility. Second, reflexivity, instead of playing a pure passive role in reflecting an underlying reality, financial markets also have an active role. They can affect the future earnings flows they are supposed to reflect. That is the point that behavioral economists have missed. Behavioral economics focus only on half of the reflexive process, cognitive fallibility leading to the mispricing of assets, and does not concern itself with the effects of the mispricing can have on the fundamentals. There are various pathways by which the mispricing of financial assets can affect the so-called fundamentals. The most widely used are those that involve the use of leverage, both debt and equity leveraging. For instance, companies can improve their earnings per share by issuing shares at inflated prices, at least for a while. Markets may give the impression that they are always right, but the mechanism at work is very different from that implied by the prevailing paradigm. Markets affect fundamentals they are supposed to reflect. Third, the human uncertainty principle turns that economic theory treats as timeless generalizations into a time-bound historical process. If agents act on the basis of their imperfect understanding, equilibrium is far from a universally and timelessly prevailing condition of financial markets. Markets may just as easily tend away from a putative equilibrium as perverted. Instead of a universally and timelessly prevailing equilibrium becomes an extreme condition in which subjective market expectations correspond to objective reality. Theoretically, such a correspondence could be brought about by either the cognitive or the manipulative function by itself. Either perceptions can change to match reality, or perceptions can lead to actions that change reality to match perceptions. But in practice, such a correspondence is more likely to be the product of a reflexive interaction between the two functions. Whereas traditional economics views equilibrium at the normal, indeed necessary state of affairs, I view such periods of stability as exceptional. Rather, I focus on the reflexive feedback loops that characterize financial markets and cause them to be constantly changing. Negative versus positive feedback loops. Reflexive feedback loops can be either negative or positive. Negative feedback brings the participants' views and the actual situation closer together. Positive feedback drives them further apart. In other words, a negative feedback process is self-correcting. It can go on forever. And if there are no significant changes in external reality, it may eventually lead to an equilibrium in which the participants' views come to correspond to the actual outcome. That is what rational expectations theory expects to happen in financial markets. It postulates that there is a single correct set of expectations that people's views will converge around, and the deviations are random. There's no built-in divergence between participants' forecasts and what comes to pass. That postulate has no resemblance to reality, but it is a core tenet of economics as it is currently taught in universities and even used in the models of central banks. In practice, market participants' expectations diverge from reality to greater or lesser extent, and their errors may be correlated and significantly biased. That's the generic cause of price distortions. So equilibrium, which is the central case in mainstream economic theory, turns out to be an extreme case of a negative feedback, a limiting case in my conceptual framework. Since equilibrium is so extreme that it's unlikely to prevail in reality, I prefer to speak of near equilibrium conditions. By contrast, a positive feedback process is self-reinforcing. It cannot go on forever because eventually the participants' views would become so far removed from reality that the participants would have to recognize them as unrealistic. Nor can the iterative process occur without any change in the actual state of affairs because positive feedback reinforces whatever tendency prevails in the real world. Instead of equilibrium, we are forced with a dynamic disequilibrium, or what may be described as far from equilibrium conditions. There are myriad feedback loops at work in financial markets at any point in time. Some of them are positive, others negative. As long as they are more or less in balance, they cancel out each other and market fluctuations do not have a definite direction. I compare these swings to the waves sloshing around in a swimming pool as opposed to the tides and currents that may prevail when positive feedbacks preponderate. Since positive feedbacks are self-reinforcing, occasionally they may become so big that they overshadow all other tendencies in the market. Negative feedback loops tend to be more ubiquitous, but positive feedback loops are more interesting because they can cause big moves both in market prices and in the underlying fundamentals. A positive feedback process that runs its full course is initially self-reinforcing in one direction, but eventually it is liable to reach a climax or reversal point, after which it becomes self-reinforcing in the opposite direction. But the positive feedback process do not necessarily run their full course. They may be aborted at any time by negative feedbacks. Boom-bust processes. Building on these ideas, I have developed a theory about a boom-bust process, or bubbles. Every bubble has two components: an underlying trend that prevails in reality and a misconception relating to that trend. A boom-bust process is set in motion when a trend and a misconception reinforce each other. The process is liable to be tested by negative feedbacks along the way, giving rise to a climax that may or may not turn out to be genuine. If a trend is strong enough to survive the test, both the trend and the misconception will be further reinforced. Eventually, market expectations become so far removed from reality that people are forced to recognize that a misconception is involved. A twilight period ensures, during which doubts grow and more people lose faith, but the prevailing trend is sustained by inertia. As Chuck Prince, former head of Citigroup, said during the twilight of the super bubble that culminated in 2008, as long as the music is playing, you have got to get up and dance. We are still dancing. Eventually, a point is reached when the trend is reversed. It then becomes self-reinforcing in the opposite direction. Boom-bust process tends to be asymmetrical. Booms are slowly to develop and take a long time to become unsustainable. Busts tend to be more abrupt due to forced liquidation of unsustainable positions and the asymmetries introduced by leverage. The simplest case is a real estate boom. The trend that precipitates it is easy credit. The misconception is that the value of the collateral is independent of the availability of credit. As a matter of fact, the relationship is reflexive. When credit becomes cheaper and more easily available, activity picks up and the real estate values rise. There are fewer defaults, credit performance improves, and lending standards are relaxed. So at the height of the boom, the amount of credit involved is at its maximum. And a reversal precipitates forced liquidation, depressing real estate values. Amazingly, the misconception continues to recur in various guises. Other bubbles are based on different misconceptions. For instance, the international banking crisis of 1982 resolved around sovereign debt, in which case no collateral was involved. The creditworthiness of the sovereign borrower was measured by various debt ratios, such as debt to GDP or debt service to exports. These ratios were considered objective criteria, but in fact they were reflexive. When the recycling of petrodollars in the 1970s increased the flow of credit to countries like Brazil, their debt ratios improved, which encouraged further inflows and started a bubble. In 1980, Paul Volcker raised interest rates in the United States to arrest inflation, and the sovereign debt bubble burst in 1982. Bubbles are not the only form in which reflexivity manifests itself. They are just the most dramatic and the most directly contradictory to the efficient market hypothesis, so they deserve special attention. But reflexivity can take many other forms. In currency markets, for instance, the upside and the downside are symmetrical, so that there is no sign of asymmetry between boom and bust, but there is no sign of equilibrium either. Freely floating exchange rates tend to move in large multi-year waves. Markets versus regulators. One of the most important and interesting reflexive interactions takes place between the financial authorities and the financial markets. Because markets do not tend toward equilibrium, they are prone to produce periodic crises. Financial crises lead to regulatory reforms. That is how central banking and the regulation of financial markets have evolved. Financial authorities and market participants alike act on the basis of an imperfect understanding, which makes the interaction between them reflexive. While bubbles occur only intermittently, the interplay between authorities and markets is an ongoing process. Misunderstandings by either side usually stay within reasonable bounds because market reactions provide useful feedback to the authorities, allowing them to correct their mistakes. But occasionally, the mistakes prove to be self-validating, setting in motion vicious or virtuous circles. Such feedback loops resemble bubbles in the sense that they are initially self-reinforcing but eventually self-defeating. Indeed, the intervention of the authorities to deal with a periodic financial crisis played a crucial role in the development of a super bubble that burst in 2007 to 2008. The interplay between markets and regulators is also at the heart of the euro crisis. The euro crisis. I have been following the euro crisis closely ever since its inception. I have written numerous articles that have been collected in a book. It would be impossible to summarize all my arguments for this essay. Therefore, I shall focus only on the reflexive interaction between markets and authorities. Both acted on the basis of their imperfect understanding. The design of the common currency had many flaws. Some of them were known at the time the euro was introduced. Everybody, for example, knew that it was an incomplete currency. It had a central bank, but it did not have a common treasury. The crash of 2008, however, revealed many other deficiencies. In retrospect, the most important was that by transferring the right to print money to an independent central bank, member countries ran the risk of default on their government bonds. In a developed country with its own currency, The risk of default is absent because it can always print money. But by ceding or transferring that right to an independent central bank, which no member state actually controls, the member states put themselves in the position of third world countries that borrow in a foreign currency. This fact was not recognized either by the markets or by the authorities prior to the crash of 2008, testifying to their fallibility. When the euro was introduced, the authorities actually declared government bonds to be riskless. Commercial banks were not required to set aside any capital reserve against their holding of government bonds. The European Central Bank accepted all government bonds on equal terms at the discount window. This set up a perverse incentive for commercial banks to buy the debt of the weaker governments in order to earn what eventually become just a few basis points, because interest rates on government bonds converged to practically zero. This convergence in interest rates caused a divergence in economic performance. The weaker countries enjoy real estate and consumption booms, while Germany, which was dealing with the burden of a reunification, had to adopt fiscal austerity and structural reforms. After the Lehman bankruptcy, European finance ministers declared that no other systematically important financial institution would be allowed to fail. Chancellor Merkel then insisted that the obligation should fall on each country individually, not on the European Union or the Eurozone collectively. That was the onset of the Euro crisis. It took markets more than a year to react to it. Only when Greece revealed a much larger than expected fiscal deficit did markets realize that Greece may eventually default on its debt, and the risk premiums with vengeance not only on Greek bonds, but also on the bonds of all the heavily indebted member countries. A Greek default would have created a worse banking crisis than the Lehman bankruptcy. The authorities put together a number of rescue packages, but they always did too late. So conditions in Greece continued to deteriorate. This set a pattern for the other heavily indebted countries such as Spain, Italy, Portugal, and Ireland as well. While the actions of the ECB have calmed the markets, the crisis is still far from resolved. Rather than an association of equals, the Eurozone became divided into two classes, creditors and debtors. In a financial crisis, the creditors call the shots. The policies they are imposing perpetuate the division, because the debtors have to pay risk premium not only on government bonds, but also on bank credit. The additional cost of credit, which is a recurrent burden, makes it practically impossible for the heavily indebted countries to regain competitiveness. This is not the result of an evil plot. It was caused by a lack of understanding of the extremely complicated reality. In my articles, I put forward a series of practical proposals that could have worked at the time, but became inadequate soon thereafter. Conversely, had the authorities adopted earlier some measures that they were willing to adopt later, they could have arrested the downward and then reversed it by adopting further measures. As it is, they have managed to calm the crisis but failed to reverse the trend. This analysis emphasized the vital role that fallibility plays in shaping the course of history. there would have been no crisis without it. It also shows that in far from equilibrium conditions, the normal rules do not apply. One of the reasons why the crisis persists is that the Eurozone is governed by treaties that were designed for near equilibrium conditions. Obviously, economists relying on the prevailing paradigm could not have reached this conclusion. Toward a new paradigm, one of the most powerful concepts for the purpose of a simplification is the concept of change. In my first philosophical essay, Soros 1962 and 2006, written under the influence of Karl Popper, I used the concept of change to build models of social systems and reflexively connect them to modes of thinking. I linked organic society with the traditional mode of thinking, open society with the critical mode, and closed society with the dogmatic mode. It can be seen that my conceptual framework extends to a much broader area than that covered by economic theory. But the financial markets provide the best laboratory for studying far from equilibrium situations at work because they manifest themselves in fat tails that can be clearly observed in the data. They can be studied in other fields as well, but only in the form of a historical narrative, as I have done in my analysis of the Euro crisis, which weaves together politics with financial economics. Reflexivity has been largely neglected until recently because it connects different fields studied by different disciplines. The same applies to my entire conceptual framework. It connects ideas with reality. Reality has been broken up into narrow fields of specialization. This has brought great benefits, but it has a major drawback. Philosophy that deals with reality as a whole has fallen out of favor. It needs to be rehabilitated. Mainstream economics tried to seal itself off from reality by relying on postulates that turned out to be far removed from reality. The financial crisis of 2007 to 2008 and the subsequent events exposed the weakness of this approach. The bankruptcy of Lehman Brothers was also the bankruptcy of the prevailing paradigm. There is an urgent need for a new one. This essay has shown that my interpretation of financial markets, based on my theory of reflexivity, is radically different from orthodox economics, based on efficient markets and rational expectations. Strictly speaking, both interpretations are pseudo-scientific by Popper standards. This is why I called my first book The Alchemy of Finance, and that is why some proponents of the efficient market hypothesis is still defended in the face of all the evidence. Nevertheless, I contend that my interpretation yields better explanations and predictions than the prevailing paradigm. How can I reconcile this claim with my starting contention that the future is inherently uncertain and the financial markets are inherently unpredictable? By resorting to Popper's logic of scientific discovery as a market participant, I formulate conjectures and expose them to refutation. I also assume that other market participants are doing the same thing, whether they realize it or not. Their expectations are usefully aggregated in market prices. I can therefore compare my own expectations with prevailing prices. When I see a divergence, I see a profit opportunity. The bigger the divergence, the bigger the opportunity. Popper made a similar assertion about a scientific hypothesis. Philosophers of science roundly criticized him for this on the grounds that the predictive power of scientific theories cannot be quantified. It may not work for scientific theories, but I can testify from personal experience that it does work in the alchemy of financial markets. When a price behavior contradicts my expectations, I have to re-examine my hypothesis. If I find myself proven wrong, I take a loss. If I conclude that the market is wrong, I increase my bet, always taking into account the risk that I'm bound to be wrong some of the time. This works well in markets that are efficient in the sense that transaction costs are minimal. It does not work in private equity investments that are not readily marketable. My performance record bears this out. I was successful in markets but not in private equities. My approach can also be useful in formulating policy recommendations, as my articles on the Euro crisis demonstrated. Conclusion. Ever since the crash of 2008, there has been a widespread recognition, both among economists and the general public, that economic theory has failed. But there is no consensus on the causes and the extent of that failure. I have argued that the failure is more profound than generally recognized. It goes back to the foundation of economic theory. Economics tries to model itself on Newtonian physics. It sought to establish universally and timelessly valid laws governing the reality. But economics is a social science, and there is a fundamental difference between the natural and social sciences. Social phenomena have thinking participants who cannot base their decisions on perfect knowledge. Yet, they cannot avoid making decisions, since avoiding them also counts as a decision. They introduce an element of indeterminacy into the course of human events that is absent in the behavior of inanimate objects. The resulting uncertainty hinders the social sciences in producing laws similar to Newtonian physics. Yet once we recognize the difference, it frees us to develop new approaches to the study of social phenomena. While they have not yet been fully developed, they hold up great promise. The stakes could not be higher. The mistaken theories that allowed the super bubble to build, the policy errors that were made in the wake of the crash, and the ongoing mishandling of the Euro crisis highlighted the human suffering that can result from a fundamental misunderstanding of the nature of the economic systems. Recognizing the implications of our fallibility will be a great improvement in our understanding. Interpreting the economy as a reflexive system may not prevent future bubbles, crashes, or policy errors, but it may enable deeper insights into economic and social-political phenomena and help humankind to better manage its affairs in the future. I realize that my approach is still very rudimentary. For most of my life, I developed it in the privacy of my own mind, only in recent years did I have the benefit of a substantive criticism. It remains to be seen whether my conceptual framework can develop into a new paradigm. Much depends on whether reflexive feedback loops can be properly modeled. There is an obvious problem with modeling. Naïve uncertainty cannot be quantified, but it may be possible to identify trends without quantifying them and changing trends without specifying the time of their occurrence. This is what I have done in my boom-bust model. We can also use volatility, which is quantifiable, as a substitute for uncertainty. And there may be other techniques that address these issues, such as imperfect knowledge economics. Friedman and Goldberg 2013, a new approach is yet to be invented. The new paradigm is bound to be very different from the one that failed it. It cannot be timeless. It must recognize that some changes are non-recurring, while others exhibit statistical regularities. Moreover, economic theory will not be able to seal itself from other disciplines and from reality. There may be room for a series of paradigms linking economics with other disciplines like climate science. Obviously, I shall not be able to develop these ideas due to my age. My creative years are nearly over. That is why I have established the Institute of New Economic Thinking. I look to this institute to build on the philosophical foundations I have outlined here. That's the end of this article.